Howdy. What if I told you that there's a REIT paying a 7% dividend yield? It's the highest it's been in over a decade. And it's got companies like Eli Lilly, Google, and Moderna writing it rent checks every month. Here's the kicker. That 7% dividend yield, it's well covered by cash flows, and the balance sheet is rock solid. It's got an investment grade credit rating. So in this video, we're going to break down Alexandria Real Estate and tell you all about this company, the opportunity, and I'm also going to tell you about the one major risk that you need to know about before you think about investing any money. Stick around. All right, let's get into it. Alexandria Real Estate, ticker ARE, is trading around $72 a share as of this recording. So let's talk about the dividend yield. The coverage is rock solid. This isn't some high yield trap. It has plenty of cash flow to cover the dividend. And the company's raised its dividend for 15 straight years, averaging over 5% increase every single year. Second, the balance sheet. It's rock solid. The debt to equity is about 60%. And get this, their average debt maturity, it's over 12 years, and the interest rate is under 4%. 3.86 is about their average interest rate they're paying. So they've locked in cheap money for over a decade. Third, like I said, their tenants aren't shaky retail stores or startups. These are massive companies. Bristol-Myers Squibb, Eli Lilly, Google. These guys are writing rent checks every single month, and they're locked into long-term leases. So what is Alexandria Real Estate? Well, this isn't your typical REIT that owns shopping malls or office buildings. They're very specialized. They put up biotech and life science laboratories in absolutely prime locations. Think San Francisco, Boston, San Diego. But their strategy gets even more specific. They don't just put up laboratories and office space and hope that biotech companies move in. They build what they call mega campuses. These are very specialized real estate development projects. They include laboratories, clean rooms, office space. This is state-of-the-art stuff. All of the infrastructure needed for research. But they also include amenities like cafes, gyms, lots of parking, and they locate these near major research universities. So think Harvard, UCLA, that kind of thing. So why do they do this? Because biotech companies want the absolute best talent, and the absolute best talent either comes from those universities or they want to work near them. So now we can talk numbers. Last year they did over $3 billion in revenue. Funds from operations was about $8.11. And they've lowered guidance for this year, but they're still guiding for about $9.26 in FFO, which is still 15% growth year over year. So the stock's trading at under 8 times forward FFO. When you compare that with a typical REIT, they're trading about 14 times forward FFO. So it's currently at a significant discount. Occupancy rates are about 91.7% in Q1. That is down about 3% from Q4 last year. But Alexandria says 2/3 of that is explained by things they knew were happening. One of the major ones is that Moderna moved out of their headquarters and into a new state-of-the-art facility. Now that's from one Alexandria building to another. So Alexandria actually built Moderna their new headquarters. So some of this isn't tenants leaving Alexandria properties, it's Alexandria upgrading the facilities for their tenants. And I do really like management's capital allocation. One thing they've been doing is selling off non-core assets and recycling that capital into developing more mega campuses. The other interesting thing they're doing is that they've actually been buying back some shares lately, and that's kind of unusual for a REIT, especially one that's been growing. But we do need to talk about the one major risk that's facing Alexandria at this point. They're 100% concentrated in US life science companies. And while that is a strength, it's probably also their greatest weakness. If anything disrupts that industry, Alexandria is going to get hit hard. There's no diversification to protect them. And right now, there are a lot of political headwinds against US life science companies and the industry as a whole. The administration's cutting grants, research funding. The current proposal for the budget going through Congress has large cuts to the Department of Health and Human Services, and they fund not only directly some of the research for these biotech companies, but they also fund a large portion of the basic research that the biotech companies tend to build on. There's even talk from Secretary Kennedy of stopping some of the government-funded scientists from publishing in scientific journals. Now, I'm not here to get political. I try very hard not to invest based on politics, but I think we do have to recognize that Alexandria's future is heavily tied to government policy and spending on US biotechnology. So if that funding dries up, or if the policy towards biotech companies or the industry as a whole becomes unfriendly, that is going to seriously impact Alexandria moving forward. So with all that said, why might this still be a compelling investment? Well, first, innovation doesn't stop. There is private biotech funding that can step in. And companies like Eli Lilly aren't going anywhere overnight. They're still going to need lab space. They're still going to do research. Second, Alexandria has built something that's really hard to replicate. You can't just throw up a life science laboratory next to Harvard overnight. They have deep relationships. They've gone through the permitting process. They have the land already locked up. So a competitor is going to have a hard time duplicating exactly what Alexandria has built. Third, that valuation is genuinely attractive. They've been growing dividends for 15 years. The dividend's well covered by FFO. The balance sheet's solid, and you're getting paid over 7% per year in dividends to wait and see what happens with this political situation and the life science industry as a whole. And finally, if the biotech industry does start to boom, Alexandria is going to be a direct beneficiary of that, and the stock price could potentially re-rate rather quickly. So the bottom line is that Alexandria isn't a typical REIT. It's actually a bet on future US innovation. And the fundamentals are strong. It's got great tenants, it's got great cash flow, it's got a solid balance sheet, and it's got an attractive dividend history. But it also has significant concentration risk in an industry with significant political headwinds. So my take is, if you believe in the future of the US biotech industry and you're confident and comfortable with that industry concentration, it might be a compelling addition to a dividend portfolio, but make sure you do understand the risks and make sure you size the position accordingly. And if it's just too risky for you, you don't like that concentration, and you're not sure what the future of the industry is going to look like, well, it's always okay to pass. You don't have to get every single investment right. If you found this breakdown helpful, make sure you subscribe and hit the notification bell. We're always looking at potentially interesting dividend opportunities like Alexandria here at Compounding Dividends.